Mhm.
Silver is incredibly volatile, both to the upside and the downside. It's the upside that comes next. As to a squeeze, I think the squeeze comes about, if it comes about, because the trading volume in the futures market is so extraordinary relative to the amount of gold available for good delivery in the physicals market. The gold price was up, but the gold mining shares weren't up. That was easy to explain in two fashions. One, the gold price was up because foreign central banks were buying gold and they weren't buying gold shares. So an asset class that had a bid was going up, while one that didn't have a bid was going down.
If you are reshoring all the gold, you let the price rise, 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 rise. Even Luke Gromen thinks it'll get to 4, 5, 6, 7,000, and then they'll revalue it. Now, gold is held on every central bank balance sheet in what's called the gold revaluation account. You can't make it up. That's the name of it.
The official sector is reshaping the gold market, with central banks adding over 1,100 tons to reserves in 2022, the most significant increase since 1967. This signals an important shift in global capital flows and a decline in confidence in fiat currencies. Rick Rule views this as the start of a broader movement that will extend into mining equities and the broader precious metals sector. Rick Rule, a legendary resource investor and former CEO of Sprott U.S. Holdings, believes this marks just the beginning of a much larger movement, one that will eventually spill over into the mining equities and broader precious metals complex. In this evolving environment, Rule points out a striking divergence. While gold prices were rising, gold mining shares initially lagged. The explanation is simple yet revealing. Central banks were bidding up physical gold, not mining stocks, creating an imbalance in capital flow within the sector. This lag, however, has now been corrected dramatically. As rising gold prices boosted miners' profit margins, stocks like Wheaton Precious Metals and Agnico Eagle surged between 100% and 150% over the past 18 months. For Rule, this price action confirms a key thesis. We are no longer waiting for a gold bull market, we are in it. Precious metals bull markets rarely end with gold, and Rick Rule notes that silver often takes the lead once momentum builds and generalist investors enter the market. With its lower cost and high volatility, silver tends to outperform during these phases. Rule warns of a potential short squeeze forming, as futures trading volumes often exceed available physical supply by as much as 200 to 1. A modest shift toward physical delivery could trigger a sharp price spike. He views the current breakout not as a temporary rally but as the start of a sustained acceleration in the sector. Historical patterns, like the 2009 to 2011 silver surge from $12 to nearly $50, suggest that silver could once again deliver explosive upside. In this video, we delve into Rick Rule's insightful analysis of the evolving precious metals bull market, from central bank gold accumulation to the unfolding setup for a silver breakout. With futures market imbalances and historical patterns aligning, Rule believes silver is poised for a dramatic move higher. So stay tuned. And if you find value in serious, data-driven commentary on the financial system, make sure to like this video and subscribe to the channel for more weekly insights. We appreciate your support and hope you enjoy the video.
The gold price was up, but the gold mining shares weren't up. That was easy to explain in two fashions. One, the gold price was up because foreign central banks were buying gold and they weren't buying gold shares. So an asset class that had a bid was going up, while one that didn't have a bid was going down. In past bull markets, it has taken a while for the increase in the gold price to follow through to generate increased free cash flow among the gold miners. And that happened in 2024 in spades, and it's happening in 2025 in spades.
Mhm.
What that means is that the prices of the gold miners, as an example, Wheaton Precious Metals, who was an exhibitor, Agnico Eagle, who was an exhibitor, those companies are up in the last 18 months uniformly 100 to 150%. And it's follow through, I think, gold to the gold shares that attracted our attendees. The thesis is proven. They don't now have to feel like they have to wait for a gold bull market. They understand that they're in a precious metals bull market and that they're in it right now. For the viewers who aren't familiar with this statistic, in the period 2000 to 2010, when the gold price went up sevenfold, the free cash flow per share of the gold miners actually declined. A decade of ridiculous malinvestment of capital. The management teams that presided over that dismal performance, have been thanked and excused. But the institutional investors and the management teams themselves have kept the mining companies on a very tight leash with regards to capital deployment. My suspicion is that as the metrics around gold companies' valuations increase in a bull market, and as investor concern about companies' ability to maintain or grow their production increases, then you will see increased investment activity, including increased merger and acquisition activity. So I think what you describe as the calm before the storm is completely accurate. I've asked most of my attendees to focus on the best names, the best of the best. The Agnicos of the world, the Francos, the Wheatons, give you surprising performance in a gold bull market with almost no operational risk. For myself, I bought those names 4 years ago and 5 years ago, so I don't have to buy them now. What I'm doing now is coming down the quality trail, looking for big single mine companies that would make attractive bolt-on acquisitions and ones that are cheap. I need to mention too, Jeremy, that I'm much more willing than most to accept political risk.
Yeah.
So names like West African Resources in Africa, Endeavour Mining in Africa are appealing to me because I'm willing to take political risk and because they're extremely cheap by any metric. I personally, too, am going down into the exploration space because I like to be involved in markets where I don't have much company and very much competition. I wouldn't expect the bull market to expand into the exploration space per se for 18 to 24 months. But I like to be in space before the competition is. Precious metals bull markets are led by gold. They're led by the fear buyer. They get kicked off because savers and investors are concerned about the deterioration of the purchasing power of domestic currencies, fiat currencies, in regular savings products. Gold moves first. When the move in gold allows producer margins to expand, the senior gold stocks move next, which is what we've just seen. At some point in time, the momentum in both gold and gold stocks attracts the generalist investor into the precious metal space. When that happens, perhaps because of its lower unit cost, leadership goes from gold to silver. I've watched this happen 3 times before in my life, and Jeremy, believe me, you will not need Rick Rule to tell you when it occurs. Silver is incredibly volatile, both to the upside and the downside. It's the upside that comes next. As to a squeeze, I think the squeeze comes about, if it comes about, because the trading volume in the futures market is so extraordinary relative to the amount of gold available for good delivery in the physicals market. Many days, single days, the trading market trades 200 times the amount of silver available for good delivery on the market. The potential for a fairly small number of the futures contracts to hold for delivery and the impact of what that would have on physically available supply could be dramatic. Well, I think gold is showing you one thing. When people ask me when gold's going to move, I say, year 2000, it's up 9% for 25 years. It's held its value. The fact that it's held its value relative to Canadian dollar savings products or American dollar savings products is becoming apparent to more people as they trust less. Gold does less well. How we solve society's problems in the United States and Canada, how we come to grips with the fact that our collective expenses are overwhelming our individual ability to create wealth is a very different problem. Perhaps we can deal with that in a subsequent Kitco interview because we can't solve that problem in the time we have left today. Well, Jeremy, I think what we need to differentiate between the squeeze that we'll likely see and the squeeze we won't see. There are some silver bugs who suggest that there will be no silver available. And as a consequence of that, there will be the mother of all short squeezes on the futures market. That won't happen. Silver futures markets are owned and made by the dealers, by the banks. What will happen in the event that there is a temporary unavailable of metal, that the markets will suspend the contracts and cash settle? That's what will happen. This will be extremely pleasant for the people who are long and extremely unpleasant for the people who are short. But it won't be the sort of incurable market imbalance that many of the silver bulls dare dream for. The physical holder probably in percentage wise benefits the least. The leveraged futures holder maybe more. The silver producer a lot. But the answer to that is yes, yes, and yes. And of course, the penalty is borne by those who didn't participate, or there is a real shortage of decent quality silver companies. And that's been noted in 3 prior bull markets. My friend Doug Casey described the circumstance where the generalist investor money comes in the silver equity space as trying to siphon Hoover Dam through a garden hose. There just aren't enough. And the big silver names are becoming less silver-centric. The go-to name in the last bull market was, of course, Ross Beatty's entry, Silver Standard, where over 50% of revenues are now gold revenues. There is still a silver constituency. For those people who would like equity vehicles that are very responsive to the silver price, traditionally those include Core Mining, Hecla, and First Majestic Silver. For people who want really high quality silver names that are maybe less correlated to the silver market, one likely needs to look south of the border. One looks to Fresnillo. One looks to Peñoles, one looks to Buenaventura. Among the juniors, we had a great list at the conference. We had Aya Gold and Silver, a great small producer. We had Vizsla Silver. We had Abra Silver. Very, very, very small, but list of very high quality discoveries. That's a very important note. You missed it by a decade, but in the 70s, the U.S. dollar lost 75% of its purchasing power, according to the Office of Management and Budget. I believe, and I said at the conference, that I believe that the U.S. dollar will, in an absolute sense, lose 75% of its purchasing power in the next 10 years, too. If we look at the decade of the 1970s for guidance, then, it's important to note that while the U.S. dollar lost 75% of its purchasing power, gold went up 30-fold. I'm not suggesting that gold's going to go up 30-fold, because since 2000, it's already gone up 12-fold. But I would suspect that the gold price gain may very well mirror the decline in the purchasing power of the U.S. dollar. If the U.S. dollar loses 75% of its purchasing power, one would expect gold to mirror that on the upside.
While gold's role in the global financial system is gaining renewed attention, Andy Schectman points to a more radical possibility: a deliberate revaluation by the U.S. Treasury. With gold already recorded on every central bank balance sheet under the gold revaluation account, Schectman believes the U.S. may allow gold to rise organically to $4,000 to $7,000 before executing a formal reset. Analysts like Luke Gromen support this view, seeing a higher gold price as the foundation for a new global monetary structure. Schectman argues the Treasury wouldn't need to sell gold to set its price, only offer to buy it at, for example, $10,000 per ounce. That bid alone would reset the global price, as no one would sell for less than that. Crucially, the U.S. wouldn't need to buy large amounts. Just setting the bid establishes the benchmark. In this framework, gold doesn't replace the dollar but acts as trusted collateral behind it, restoring confidence and stability to a fragile financial system. Jim Rickards is also drawing attention to a scenario that, while once considered extreme, is gaining new relevance: a revaluation of gold to $24,000 per ounce. He argues that such a move, though inflationary and massively devaluing to the dollar, would deliver a windfall of around $6 trillion to the Treasury General Account, benefiting central banks worldwide. The idea, long dismissed as fringe, is resurfacing as gold has surged over 40% in the past year, from under $2,400 to over $3,400, while U.S. national debt nears $37 trillion. This sharp divergence between gold and sovereign debt has revived serious discussion around using America's gold reserves as a monetary lever, and a recent research note from the Federal Reserve suggests the concept may not be as implausible as it once seemed. Let's get back to the interview.
Is first and foremost, let's look at, we've become a net importer of gold, and month over month we're seeing massive inflows of gold every single month. I asked Judy Shelton, who was Trump's nominee to run the Fed in 2016, do you think that they're going to issue gold-backed treasuries? That was what her book was all about. On my interview with her, she said there is no question, in no uncertain terms did he say to me, July 4th, 2026, he will do that. It's a big day for him. It's the 250th year anniversary of the country, and he will issue gold-backed treasuries on the back end of the market that day. Now think about this. If you are reshoring all the gold, you let the price rise. Even Luke Gromen thinks it'll get to 4, 5, 6, 7,000, and then they'll revalue it. Now, gold is held on every central bank balance sheet in what's called the gold revaluation account. You can't make it up. That's the name of it. If they did revalue, first of all, it would benefit every central bank on the planet. The Treasury only needs to tell the Federal Reserve, revalue the price of gold right now. And they do. Bang, it's done. No congressional approval. Every $4,000 increase in the price of gold would give the Treasury General Account $1 trillion free and clear. If they moved it, as Jim Rickards says, to $24,000 an ounce, as crazy as that sounds, It would benefit all the central banks. It would massively devalue the dollar, to your point, create tons of inflation. But now that would give the Treasury General Account $6 trillion free and clear. The Treasury issues gold certificates to the Federal Reserve. The Federal Reserve takes the gold and holds it, prints the money, the $6 trillion, which devalues the dollar tremendously, just like Roosevelt did in 33, gives the money to the Treasury. Now, the Fed doesn't own that gold. They own the dollar value of the gold. The gold belongs to the Treasury and to the American people. Now they start paying down their debt. They don't have to issue any long-term Treasury. They flood the market with stablecoin issuance on all the cryptos that fund the short-term Treasury debt to keep the game going. And with low interest rates, if you back the Treasury, the long end, like the 50-year to start with, as Judy says, and then 30 and 20 and 10 later, shorter durations over time, you can peg a zero interest rate to the long end of the curve. Zero interest rate, zero coupon, redeemable in gold. That gold is the inflation barometer. The more stupidity we use in monetary policy, the higher the price of gold goes. So we say, take our long-term Treasury. You can still trade it the way you always do, giving you great liquidity, but it is redeemable in the end in gold. Judy Shelton says they'll issue stable coins off of those too, giving more energy to the short front end of the curve. And now you have zero interest rates on the long end, redeemable in gold way down the road, starting at 50, 30, and then 20 and 10 over time. But now you can bring back your manufacturing in an era of a very devalued dollar and very low interest rates on the long end. Bring back your manufacturing, reshore your manufacturing, and grow your way out of this mess that we find ourselves in. It is, in my mind, the only way out. You can hyperinflate, you can default, or you can do a soft default on the dollar, which I think they're going to do. They're going to destroy it. You save in dollars, you're going to go broke, period. So they will print their way out of this problem to print the $37 trillion in debt in 3 years, but they will peg the Treasury to gold, probably revalue it, which devalues the dollar, allows them to pay off the debt, some of it, and not issue long-term debt for a couple of years anyway, with all the money they take in from the Fed on the Treasury General Account issuance of gold certificates. With those low interest rates and cheap dollar, you bring back your manufacturing, you retool, and you grow your way out of this problem. If you just would have kept your money in gold instead of dollars, it'd be easy, right? Because in 2005, the average price of a house was, I just was looking at this the other day, 2005, it took about, take about 800 ounces of gold to buy a house in 2005, with gold right around, call it $400 an ounce. 800 times 400 is $320,000. So let's just say that you sold your house in 2005 for $320,000, and you kept the proceeds in gold since 05. And I can go back to 1960 and draw the same analogy, by the way, which I'm happy to do for you after here. But you decide to put it in gold. Everyone says you're a fool. Don't do it. There's better places to put it. Well, you put it in gold and you leave it there, because gold has smoked the real estate market since 05, and go back even further. But the point of it is that those 800 ounces today at $3,400 is $2.5 million or more, whereas almost 3 million. Is that right? 800 times 3,400, $2,700,000, right? That $320,000 doesn't even buy you a house right now, as the average price is over $400,000. The point of it is the dollar is losing value against things like real estate. Saving in dollars, you're destined to go broke. You put it in gold, well, it doesn't earn any interest. Who gives a crap? It keeps pace with inflation. Go back to 1960 and do the same thing. The price of gold was $35 an ounce. The Census Bureau will tell you a house was $17,000 in 1960. Do the math. $17,000 divided by 35 is 485 ounces. So your great-grandparents, I go, Grandma and Grandpa left us 485 ounces of gold. Should we just pay for the house? Or should we take out a $17,000 mortgage? They said, you know what, let's take out a mortgage. We have put 485 ounces under their mattress for the last 64 years, earning nothing but dust. And that $17,000, well, that wouldn't even buy you, all your furniture. It wouldn't even buy you a TV and a living room set and a dining room table. But the 485 ounces of gold, well, let's see, what's that worth? Times 3,400, $1,650,000. The average price of a house today, call it $400,000, it buys you 4 houses. China doesn't want to be the world reserve currency. They don't want to do that because they'll hollow out their manufacturing too. Instead, I believe gold will be the de facto reserve. It will act as the treasury. And you are seeing all sorts of things going on right now where countries are trading their own central bank digital currencies, in particular over the BRICS bridge that has now been expanded to non-BRICS nations and settling imbalances in gold. I believe that is the framework, whether it be backing the treasury and redeemability or the way that the BRICS have spoken of in their unit token and the way they're doing it right now with the expansion of the Shanghai Gold Exchange to other locations throughout the Belt Road. Redeemability will be in gold. That is not replacing the currency, but it's replacing what stands behind the currency. And it's the trust that we have squandered through weaponization, in particular against Russia.
Rick Rule sees the precious metals market entering a transformative phase, not driven by speculation, but by profound structural shifts. Central banks are buying gold at historic levels, signaling a decline in confidence in fiat currencies. This sovereign demand has begun to lift mining stocks. Still, the real momentum, Rule suggests, comes when generalist investors join in, often triggering silver's outperformance due to its affordability and volatility. Silver now faces a unique setup. Futures market leverage has vastly exceeded physical supply. Industrial demand is rising, and mining fundamentals are improving. These forces point to the early stages of a long-term, broad-based bull market in tangible assets, with silver potentially leading the charge. Meanwhile, gold revaluation, once a fringe concept, is gaining traction. Analysts like Andy Schectman and Jim Rickards argue that the U.S. could reset gold's price through strategic buying, injecting trillions into the treasury and restoring confidence without selling a single ounce. With gold already logged in central bank balance sheets under the gold revaluation account, the mechanism is in place. Central banks are accumulating. BRICS nations are preparing alternatives. The financial system is shifting, backed not by promises, but by tangible value. What happens to the global financial system when trust in fiat currencies breaks down and gold and silver return to center stage? If you found this breakdown valuable, please consider liking the video, subscribing, and sharing it with other serious investors who need to hear this. We'll continue to bring you the brightest minds in the markets and the insights to stay ahead of the storm. Thanks for watching.